And we are going to be looking, as I stated, changes in partnerships, because we would have looked at introducing partnerships. You look at what the income statement look like, the statement of appropriation, current accounts. So it gives you the basic rundown of the different accounts for a partner. And we looked at the formation basically of a partnership. That's what we would have looked at, how the partnership is forming. We look at the partnership act, etc. But now we are going to be looking at the fact that yes, we form a partnership, but there are changes to this partnership that we would have originally formed, and how are we going to deal with such changes when it comes to the partnership? Because we have our original partnership between with Julia, Chloe, and Jonathan. That's the original partnership. However, Jonathan decides to retire, and then it's only Julia and Chloe. So what are we going to do now in a situation when Jonathan retire? Okay, or what will we do in a situation if there's a death of a partner? What will we do if we have Jonathan, Chloe, and Julia, and then they decide they wanted to admit Natisha into the partnership to make it 4 persons instead of 3? What do we do when we admit a partner? Those are the questions that we want to ask. So in light of all those questions that we are looking to ask with respect to the partnership, in light of all those questions that we're asking, let's look at our PowerPoint presentation with respect to such. So let me share my screen. Let's talk about it a little bit. Now, the example question that we're going to be doing for this topic is called lean and hard. Now, this topic is going to stretch today beyond today, because I am going to introduce it today. Unfortunately, we are going to have a session on Wednesday, and I already know that some persons say they cannot make that session. And because it is instructional in nature, and that I would be most likely be explaining and demonstrating, I would record the session. And I know one person would have spoken to me that they will not be able to attend the session, and then we will come back on Friday. So if you look at your schedule, you will see that for partnership changes, that it is just not a 1 week topic. Okay, you will see that it's not a 1 week topic. The topic has stretched, I think, over 2 weeks or so. So we have partnership changes. So partnership changes, effect on the income statement, because the partnership, the changing of the partnership or changing of the composition of the partnership will affect the income statement. So how will this affect the income statement? That is what we're going to look at. So we're saying here that the composition of the partnership business can be changed at any time. That is, it could change at the beginning or at the end of a financial period, or in some cases, partway through the financial period. Now, we are saying that you have a partnership. That partnership, basically what we're saying is that the partnership between the persons who I mentioned, Julia, Chloe, and Jonathan, could change at the beginning of the financial year of the partnership, or it can change at the end of the financial year of the partnership, or in some cases, it could change in between the financial year. It could change 3 months into the financial year, 4 months into the financial year, 6 months into the financial year. A partnership can change. This part here, this part here, in some cases, partway through the partnership, this is the part that gives students problems. When the partnership change partway, there's not necessarily an issue with the beginning and the ending, but when it changes partway in the partnership, that's where students would have issues, right? Now we have 3 reasons for such changes in the partnership, in the composition of the partnership. So those 3 reasons, the first one is that existing partners decide to revise the agreement. So you have Jonathan, Chloe, and Julia. They are in partnership. Those 3 partners can decide that they want to revise their original agreement. So if they decide they're not bringing in anybody new, nobody is leaving, etc. It is just that they're not satisfied with the current agreement that they have, and they want to make changes to it. So they can make changes to the agreement. And if they make changes to the agreement, then the income statement must reflect the changes that were made to the agreement. So that is one reason. The second reason is if they admit a new partner. So they decide they're going to admit Abiyomi. So if they're admitting Abiyomi to the partnership, it means that they have to make necessary changes. And because that they would have admitted him, then the income statement must reflect the fact that they have admitted a new partner. And thirdly, you can have the retirement or death of the existing partners. So one partner could have either retire or die. So if the partner retires or dies, then the partnership changes, and there must be a reflection in the income statement of that change with respect to what happened with the partner. So now let's look at the effect of the changes. Yes, go ahead.
Say, for instance, one of the partners died. Like, say, for instance, like how you say me, Julia, and Jonathan. Say that I die, but I want to give my share to my son or daughter. Does it still need to change?
Yes, because your son or daughter may not want to agree to the terms that you would have agreed to.
So there's basically no avoiding a change whether or not.
No, because once you bring it in, once something like that happens and there's a different person altogether, you have to look at the partnership again. But what happens is the person might decide that they're going to stick to the agreement, but then obviously the names in the income statement will have to change still, because then you have you exiting and a new person coming in. So you will have to have then the setup for that new person as well.
Oh, okay. But say, for instance, I don't want my son to become a partner. I just want to give him like shares or access to what I have invested in the company. Does he still have to be part of it?
No, because you just said that you don't want your son to be a partner. You just want them to be a beneficiary of what you would have had.
Right.
Right. But remember that a partnership doesn't have shares. So don't say shares. A partnership doesn't have shares. That's a company that will have shares. But if you would have written or stipulated that what you would have been entitled to on retirement from the partnership, that's supposed to go to your son, then I believe that the partnership will have to honor that and give it to your son. But obviously the partnership still, the composition of the partnership will change, because remember, the son now is not coming in as a partner. The son is not going to be there, and you are no longer there. So it's just the other, just Julia and Jonathan. So then they have to still look at their agreement now, because it's only the two of them. So the income statement still need to reflect that change as well, because it's only two persons now instead of three.
Okay, understood. Thank you.
Thank you for those questions as well. Very good. So remember, you are free to answer questions. We have the effect of the change on the income statement. And we're seeing when the change occurs at the beginning or the end of the period, the income statement is not impacted severely. So this is important. When the change occurs, occur at the beginning, changes occur at the beginning of the or the end of the period, the income statement is not severely impacted, because the change would have occurred at the beginning, so there's nothing really supposed to do, because everything will be new. So there's no issue really. If it do at the end, there's no issue either. That is why I said this is where students get the problem, because we will most likely give you the questions where the change occurred during the financial period. We would have had situations where we would have done changes at the beginning and the end, and we would have done during the period. Now the students get so accustomed to doing a change during the period. When you come and do a test and we give you the test at the beginning, the students still trying to work it out as if it was during the period. So you have to be very careful and read the question very, very good. Okay, very critically. So the income statement is not severely impacted if the change is at the beginning or the end. The income statement reflects the profit or loss made for the new period after the change occurred. So the income statement reflects the profit or the loss made for the new period after the change occurred. Secondly, when the change, this is one here. When the changes occur partway through the accounting period, special emphasis must be taken to reflect the profit or loss before the change and after the change. So this is the one where you have those issues that you need to pay close attention to. When the changes occur partway, let's say the changes occur 3 months or 4 months or 6 months through the accounting period, special emphasis must be taken to show the profit that you would have gotten before the change, which will be in the first 3 months, if it was a 3-month change, and the profit after the change, which is the next 9 months. Okay, so that is where you get the little issue with students. So we have the income statement. We said the income statement is split at the date of the change. So that is what happens when you have the change occurring partway through the accounting period. The income statement has to be split at the date of the change. So we have given you that format in an Excel file, so you can download that format in the Excel file, and we will look at that as well. Now, continuing the effect of the change on the income statement, the profit and loss appropriation section of the income statement is affected, not the trading section. Okay, the trading section of the income statement is not affected, which means the trading, and let me tell you the trading section if you do not understand the trading section. The trading section is that section before gross profit, or the trading section is the section that allows you to work out gross profit. Okay, so your sales are not necessarily affected, your purchases, those types of things. So it tells you that the profit and loss appropriation section, which there's a section dealing with your expenses and coming down then to the appropriation account, that is what is effective, not the trading section. Secondly, separate profit and loss appropriation statements must be prepared to determine the profit or loss distributed under the old agreement and the profit and loss distributed under the new agreement. Okay, and we are going to see this in a demonstration. I'm just talking this at the point. So if you seems that you have this fuzziness or this cloud in your mind, and this is for the ones that are doing it for the first time, not the ones that would have done the course before, the ones that are doing it for the first time. If you think that there's this fuzziness in your brain and whatever mom is saying, I can't really grapple with it, when we start to demonstrate, you would kind of get an understanding of what I'm speaking about. But there's when there is a change during the financial year for the partnership, you usually have an old agreement and a new agreement, because the old agreement would be the original agreement that you would have had. And we're going back to Julia, Chloe, and Jonathan. Julia, Chloe, and Jonathan would have had an agreement during the financial year. Let's say 3 to 4 months into the financial year, Chloe, and she used death. So since she used death, I will use it, but I would have preferred to use retirement because I don't want to put death on her. But during the first, let's say 3 months into the financial year for the partnership, Chloe decides she's retiring, that she's going to retire from the partnership. So she's leaving the partnership. So what you have to do, you have to prepare financial statements for the first 3 months of the financial year and show what profit would have been made for those first 3 months when Chloe was there. And then you have to turn around, and that before you get to turn around, you have to prepare financial statements for the first 3 months of the financial year when Chloe was there, to show the profit when Chloe was there. That is considered the old agreement. And then the next 9 months when Chloe is no longer there, that is considered the new agreement. And you have to show the profit under the new agreement as well. Okay, so that is what this point here, number 2, is referring to or alluding to. The third point is that the gross profit or net profit is generated in a manner that sales were earned in the period. Okay, this will be explained when we do a question. So the gross profit or the net profit is generated in a manner that sales were earned in the period. So therefore, the gross profit or net profit is appropriated according to the uniformity of sales. Basically, what they're trying to say, just how you earn sales during the period, the profit is distributed, is broken according to that manner. But we will see it when we do a question. The fourth point states that expenses and revenues, so let me go right here, gross profit and net profit generated in a manner that sales were earned. Just how the sales were earned in the period, the profit, whether it's gross or net profit, is appropriated according to the uniformity of those sales. When it comes to expenses, these are points to note. When it comes to expenses and revenues related to sales are appropriated similarly as gross profit or net profit. So if you have an expense that is related to sales. Okay, this is critical. Make a point of that. If the expense or the revenue is related to sales, like selling and distribution is an expense, but selling and distribution have related to sales, commission on sales. So to give you an example here, commission on sales. So there's a revenue related to sales. However, your gross profit and net profit was appropriated, you have to share. When they say appropriated, they mean share. However you share the gross and the net profit with the agreements, you have to share the expense and the revenue that relate to sales in the same manner. That's what they're seeing there. Okay, so that's the point to note, and we're going to reiterate that point when we do the questions. Fifthly, all other expenses and revenue are appropriated on a time basis. So this point here is real important as well. All the other revenues are appropriated on a time basis, or let's state it otherwise. So all your other expenses, meaning the expenses and the revenues that are not related to sales. So things like electricity, things like your salary, things like your rates, rent, they're not, if it is not related to sales, it is appropriated on a time basis. And when we say time basis, we mean it has to do with the change of the partnership. So let's say that we say 3 months, 9 months for Chloe. That means your electricity will be split 3 out of 12 for the old agreement and 9 out of 12 for the new agreement, because Chloe was there for three months of the financial year. So she has to share in that part, that electricity expense there, and the other 9 months was only Jonathan and Julia. So they have to bear the burden of the other 9 months. So that's why we say time basis here. Any questions? Any questions?
No more.
Okay, more questions. Alrighty. Continuing, this is an example here. Examples of partnership changes. This first one here. We have F and G were in partnership for a few years, sharing profits and losses 2 to 3. On April 30th, 2016, F started to contribute more of his time to the business. The partners agreed to allow F a salary of $5,400 per annum. The financial year starts 1st of May each year. So this is an example of a partnership that was changed. They were sharing profits and losses 2 to 3. The original agreement does not state that F get any salary. So because the partnership changed, what happened then is that, because that F started to do more work in the business, and the part you agree that F should get an annual salary of $5,400, then that is what caused the agreement to change. Okay, that is the giving the salary to F is what caused the original agreement between the existing partners to change. Okay, so that's an example. The second one here is that S and T started a partnership on November 1st, 2015. So S and T started a partnership on November 1st, 2015, sharing profits and losses 1 to 3 respectively. So S was getting 1 out of the quarter and T was getting 3 quarters. But what happened is R is admitted into the partnership on March 31st, 2016. And the partnership agrees to equal share of profits. So here in this example, we are admitting a partner to the existing partnership. So now instead of having 2 partners, you have 3 partners. And since you have the 3 partners, you decided to share your profits and losses equally. So the profit sharing ratio has changed with the partners. So in a situation like that, you will have the all agreement where you would work out what the profit would have been up to the point of the change and share that profit between S and T. And then after the change, you will work out what the profit is under the new change and then share that equally between S, T, and R. So that is that example. All right. So that is my introduction to partnerships. In your PowerPoint, you will see that we said there's an example, Tub, Puddle, and Martin. We're not looking at that, Tub, Puddle, and Martin, but I do think that there is a presentation that has that that particular example attached to it, right? So let me come out of this presentation. And then I want to speak about revaluation. Because we have, looking for my question with Lynn and Hart. So who has a question? Somebody put something in the chat. Yes, please. It is on Trident. Okay. So Rakim was saying he was a little fuzzy with what was going on. But yes, you will get clarity, Rakim, as we go on. And yes, Alicia, this information is on Trident. Right. Now the question that we have, let's see if I have it up here. Oh, this, I was to mention this earlier on. Let me share my screen. I was to share my screen earlier on to highlight an error with Scott and Joplin. I would have told Joanna to pass it on to the group. In Scott and Joplin, the question that you had has that the motor vehicle accumulated depreciation is 3,600 and the office equipment is 12,800, which gives you a negative net book value figure for office equipment, which is incorrect. So that question, the things were interchanged when it came to the accumulated depreciation. So I re-upload the question with the correct thing here. The motor vehicle accumulated depreciation is 12,800 and the office equipment is 3,600. So if you want to, if you are doing the question, take note of the new question that is there that has the revised depreciation for those. Okay. Now,
Monica, repeat what you just said, please.
The accumulated depreciation for Scott and Joplin. Motor vehicles is 12,800 and office equipment is 3,600. The original question that you had has those figures interchange. So I have re-uploaded the new question.
Thank you.
Okay. So I was supposed to highlight that earlier on. So now this is the example question that we're going to look at. And I'm going to read through the question, just going to talk about it a little bit. And we also have, there's a presentation on revaluation and goodwill. I would also ask you to review those notes. So all your notes on changes in partnerships, I would ask that you read those notes for changes in partnerships, because I want that when you come to the session, when you would have read through those notes, there may be some questions that you have in your mind. So when you're going through the notes, make a note of things. Ask Miss Celie to explain this. Ask Miss Celie, what does this mean? Tell Miss Celie, I don't understand this particular point here. So you make a note so that when you come to the class, you come to the class saying, Miss Celie, I went through the note, but I don't understand this. Could you explain? Okay, we're going to look at it, but I need you to also read those notes. All right, all of them. So this is the question here saying Pamela Lynn and Sue Hart have operated a partnership business for several years, sharing profits and losses equally. So this is something to note. They are sharing their profits and losses equally. Okay, so this is their agreement. Originally, they're sharing profits and losses equally. Interest is paid on capital at 6%. And just remember that these percentages are per annum percentages, okay? So interest is paid on capital at a rate of 6%. And all cash drawings made by partners, so the drawings, the cash drawings made by partners is charged an interest rate of 4%. Remember, again, these percentages are per annum. The latest trial balance of the partnership at June 30th, 2013 is given below. So you have land, buildings, stock, sales, cost of sales. So they give you cost of sales, so they don't give you purchases, opening and closing inventory. So if they give you cost of sales, it is just that you need to just subtract the cost of sales from the sales figure to give you your gross profit. All right, so you don't need to work out cost of sales because they don't have opening inventory, closing inventory, purchases, or anything like that. They already give you the figures, so you just need to subtract this from the sales to get your gross profit. You have wages, office expenses, commission received, salary for lien, carriage outwards, selling expense, and you have capital accounts. Lynn and Hart, remember the original partners are Lynn and Hart, okay? Lynn and Hart capital accounts is $65,062. And then they have Brown. So that means that they are bringing in a new person. Because from the time you see Brown here, that means that they're introducing a new person, admitting a partner, okay? Because the two partners originally are Lynn and Hart. So these are the two partners, Lynn and Hart, originally. Now they're telling you about a capital account for Brown. So that means that Brown came into the partnership sometime during the year, and they have here November 1st, right? So he bringing his capital. Then you have a current account for Lynn and Hart. Not saying that you don't have one for Brown, but remember Brown was not in at the beginning. So therefore, because Brown was not a part of the partnership originally, he will not have an existing current account. In order to, he or she will not have an existing current account to have a balance on it. But Lynn has a debit balance on her current account of $800, and Hart has a credit balance of $42. You have a loan from Hart, and then you have loan interest that was paid of $200. You have cash and bank, and then you have drawings. Lynn, draw, and Hart, and then Brown also withdrew. And then you have your accounts receivable and payable. This is the receivable, this is the payable. So this is the trial balance. And the trial balance is the first indicator that you admit a partner, because it has Brown here and Brown here. All right. Good. You have additional information. The first part of additional information, it says Hart decided to retire from the partnership. So this is important. This is what's happening. Hart decided to retire from the business on October 12th, October 31st, 2012, to pursue other business interests, to pursue other interests. And it was agreed that Wendy Brown would take her place in the partnership. So you see what is happening? because you can't have a partnership with one person. If it's only one person, that's a sole trader. It cannot be a partnership if it's only one person. It will have to be a sole trader. So you had Pamela Lane and Sue Hart. They were the original partners. But Sue Hart decided that she was going to retire. And when she retired, Wendy Brown taken her place. So Wendy Brown is now an addition to the partnership. So then the partnership is going to be between Pamela Lane and Wendy Brown. But originally it was Pamela Lane and Sue Hart. So they tell you Brown invested $75,000 cash as capital. Okay, Brown invested $75,000 cash as capital, and it was agreed that she would be entitled to 2/5 of the profit of the new partnership. Let's see what the old partnership was. The old partnership was equal. So Lynn was getting half, Sue was getting half. That was the old agreement. But now under the new agreement, Brown is saying she will be entitled to 2/5 of the profit of the new partnership. So that means if Brown is getting 2/5, how much is Hart getting? Sorry, how much is Lane getting? If Brown is getting 2/5, what Lane is getting?
The remainder.
And what is the remainder?
3/5.
You're very smart. 3/5.
3/5.
Right. See, you can trick me telling me about the remainder. Thank you, Ricky. 3/5. Right. So Lane will be getting 3/5 because Brown is getting 2/5. So Lane will be getting 3/5. The new partnership also agreed, listen to this. The new partnership, the new partners also agreed that interest on capital will continue at the old rate. What was the old rate? 6% per annum. So the new partners agree that they're going to continue with the old rate on interest on capital, which is the same 6%. These are the things that you are supposed to make note of when you are doing these partnership changes and questions. You are supposed to make note of the fact that what the old agreement states. So when you read these questions, one of the things that you're supposed to do is to write down all agreement and write all of what the old partners agreed to. Write it down. All agreement, profits and losses shared equally. Interest on capital 6%. Interest on drawings 4%. And you have that there. Then you come to new agreement. And when you come to new agreement now, you will say, okay, profits and losses, 3/5, 2/5. Interest on capital 6%, because that's the same thing. And then we say, but no interest will be charged on drawings. So this is the new partnership. So then you will write no interest on drawings on the new partnership. So that when you're doing the question, when it comes to the new partnership, I should not see you calculating interest on drawings, because they said they were not charging any interest on drawings for the new partnership. The old one had interest on drawings. Then you will look at it and say Lynn will be entitled to a salary at a rate of $1,800 per annum. So this is the new partnership. Under the old partnership, Lynn was not getting a salary. But under the new partnership, she is being entitled to $1,800 per annum. And Brown, what is happening in the new partnership? Brown will be guaranteed a profit of $24,000 a month. Sorry, per annum. So Brown also has a guaranteed profit of $24,000 per annum. So these are the things you will know. You will then, again, when you are doing these questions, in your book, write all agreement and write down all the stipulations under the old agreement. And then write new agreement and write down all the stipulations under the new agreement, so that when you're doing the question, you could keep referring to the stipulations of the old and the new agreement. Okay. Number 2, on Hart's retirement, the following assets were revalued. So we have a revaluation going on. You would have done revaluation in ACCG 100. Okay, revaluation was done in that. We are revisiting that concept in this course. So on retirement, the following assets were revalued as indicated. And please note that there is a PowerPoint presentation on revaluation. Okay, land is going to be 108,000 and buildings 49,000. Now let's look back here. Land was 100,000 before, so that means land went up by $8,000. Okay, building was 54,000 before, that means buildings went down, because building is now $49,000. So that is revaluation. So you should know the accounting entries when you are revaluing your assets, and that goes back to the double entry principle of accounting. All right, stock costing $800 was agreed to have no value, while debtors owing $1,100 were declared bankrupt. Okay, so these are some things that are happening when it comes to your assets. Then they also speak about goodwill. We have a PowerPoint on goodwill as well. Goodwill was valued at $28,000, right? And it was agreed that a goodwill account will be maintained in the books of the new partnership. So what we're doing with this question, we are doing a whole set of things with this question. Normally, we would start with a question just doing basic changes, and we would just do the change and that's it. But what we have done here is we are starting with an example question that encompasses a whole set of concepts that we want to introduce to you. We are introducing the change. We want to talk to you about revaluation. We want to talk to you about goodwill. And they're telling you that the goodwill account will be maintained in the books of the new partnership. So we're going to be having discussions about what you do when the goodwill account is maintained in the books of the partnership versus when the goodwill account is not maintained in the books of the partnership. So again, that is why you have PowerPoint presentation on such. So you have a PowerPoint presentation on revaluation of assets, and you have a PowerPoint presentation on goodwill. And you also have summary notes on all of these concepts. Number 3, the business was only able to generate sales of $46,500. Walhart was a partner. So Walhart was there. They were only able to generate $46,500 in terms of sales. It was therefore agreed that any apportionment of profits will be made on the basis of the sales. Only when Hart was there, they were only able to generate $46,500 in sales, and therefore they are going to apportion the profits based on that manner. Number 4, at the end of the year, selling expenses of $380 were prepaid, while all the carriage outlay was incurred before Hart's retirement. So the carriage outwards has nothing to do with when Brown was there. All of that carriage outward happened while Hart was there. Number 5, depreciation is to be charged on buildings at a rate of 10% of valuation. And note, all expenses are to be apportioned on time basis unless otherwise indicated. So this is important. All expenses are to be apportioned on a time basis unless otherwise indicated. Number 6, Hart's existing loan was made to the business on July 1st, 2011. The sum outstanding on this account is to be repaid by the new partnership on June 30th, 2013. And number 7, Hart is to be paid $8,000 in cash on June 30th, 2013. And she has indicated to the new partners that any remaining balance owed to her should be treated as an interest-free loan to the new partnership. So all of this is important. What they're asking you to do, the revaluation account, the income statement and appropriation account for the year, the capital and current accounts for the partners in columnar format, and the statement of financial position for the new partnership. And then they have some theory questions that you should try answering. Give one reason why the fixed capital and current account are preferred over the fluctuating capital account. Explain why a partnership would agree to guarantee a minimum share of profit to a partner. And then seven, clearly explain why assets are revalued when a partner retires from a partnership. Okay, so this is the question that we have here, right? So I have some questions for you at this. What I would like to find out from you at this stage is, do you have any questions? So I'm going to be asking if you have any questions. So I'm going to call your names. So I'm going to start with Aaliyah. Miss Cox.
Yes, please. I don't have any questions at the moment.
Okay. Abiyomi?
I'm going to read this through again and get back.
Okay. All right. Alicia? And I believe that Jonathan may have a question for me. Jonathan, you have a question for me?
Right, yeah, man. You could just scroll back at there fast. I can't remember the answer. I forget it. The business, it said that the business only made a certain amount of money while Hart was there. 46. But that will come out to you want 86,000, right?
Yeah. The World Heart. There's no paper. I'm looking for my paper and can't find it. World Heart was there. They only made $46,500 for their sales. Right? Yes. And you have to use that to work out how to split the gross profit, because the total sales for the period were $186,000. But remember that you have to subtract the 91,100 from that to give you your gross profit. So you have to take the 46,500 and divide it by the 186,000, and then multiply that by whatever gross profit you calculate to determine how much the gross profit is for the point of time when Hart was there, and the gross profit for when Brown came there. That's what you have to do. You will see it when we do the question. That is clear? Oh, fuzzy. Jonathan?
Yes, please.
Okay. Okay. So Jonathan wanted to know about this part here. When he said the business was only able to generate $46,500 while Hart was a partner. So that means that because when you take 186,000 and subtract $91,100 from it, you're going to get a gross profit. Hart cannot share in that full amount of the gross profit. Why? Because while Hart was there in the business, she was only able to help the business generate a certain amount of sales. So because she was only able to help the business generate a certain amount of sales, she can only share in a profit with what she helped generate. It means all the other sales and all the other profit Brown would have helped generate. So then Brown was share with Lynn with that the other part of it, right? So I hope that is clear for everybody. I will continue asking my questions shortly to each person.